This can't be avoided. I'm your host, Steve Metre, and thanks for joining me today. And the question we should be all asking right now is, why can't a recession be avoided? Why is it seemingly inevitable at every phase in the cycle that we get a recession at some point in the near-term future? I mean, you start to look at the data. The Fed is getting exactly what they want. Inflation is starting to cool off. Now, I know it's not coming down super fast, but the trend has shifted. It's starting to head lower, and the market is excited about it. Stocks are jumping on the news because they're saying, wait a minute, hey, the Fed is about to put an end to the hiking cycle and nothing is broken. But yet we can go back in history time and time again, and for some reason, a recession in the months to come is almost inevitable, almost an absolute certainty. So the question we're going to answer in today's show is why that is. Let's go to Wall Street Journal, where we picked today's story up with the headline, CPI report shows U.S. inflation eased in November as price increases has eased this fall from a 4-decade high earlier in the year. The Labor Department said on Tuesday that its consumer price index climbed 7.1% in November from a year ago, down sharply from 7.7% in October. And mind you, one of the key things here, it beat analysts' expectations. Analysts thought the number was going to come in higher, so this was considered a beat. Of course, the market had a huge reaction to it, but let's dig a little bit further into the data. Building on the trend of moderating price increases since June's 9.1% peak. So again, the trend now is inflation is slowing. This is disinflation. Core CPI, which excludes food and energy, rose 6% in November, also missing expectations, or beating, I should say. Expectations were higher from a year earlier, easing from a 6.3% gain in October. September's 6.6% increase was the biggest jump since August 1982. So, from the headline numbers, we're seeing everything the Fed wants. It says, hey, we tighten monetary policy, we're raising rates, we're unwinding our balance sheet. You want to see inflation coming down. That's what we're starting to see. And at some point in the future, we'll get down to the range we want. And that means the pace of rate hikes, which we'll get some more information tomorrow, and we'll talk about in tomorrow's show, should slow in the next year as policymakers start to believe that they're getting ahead of inflation. Prices softened significantly on a month-to-month basis. The CPI increased a mere 0.1% in November from the prior month, compared with 0.4% in October, with expectations at 0.3%. Core CPI also rose at 0.2% in November, down from 0.3% in October, and 0.6% in August and September, also missing expectations, which were at 0.3%. The CPI measures what consumers pay for goods and services. So again, nothing but good news. And we talked about this in yesterday's show, that the long-term trend in inflation should start to come down. It doesn't have to be rapid. It just has to start trending lower. And there's some things in the CPI that are lagged effects that will come off in the months to come and will further put downward pressure on here. So again, this seems to be all good news, but the question keeps to be, why is a recession so likely to happen? Overall inflation eased since the summer as supply bottlenecks have improved. Gasoline prices fell in November, with a national average of regular unleaded gasoline at $3.26 a gallon. Again, we showed this chart in yesterday's show as prices peaked mid-June at a record $5.02 a gallon. And that's going to put further disinflation into the CPI. And at some point by the summer 2023, unless gas prices shoot way up, we're likely to see a deflationary part of the CPI. I'm not saying the whole CPI will go negative, but from the gas prices, from an energy perspective, we're really likely to see that. Because wages make up the largest cost in delivering these services, the labor market holds a key to understanding inflation in the services category. And again, we've talked about how the Fed doesn't want you to get raises, right? They kind of do, but not really, because they say, hey, if you get a raise, that means your boss, your employer, has to go and increase the price of their goods and services to compensate for higher wages. Now, that is not something you directly see in the CPI, but it is there. It is an underlying underlying component. But what we need to take away from this is this is a good sign, because what you want to see is prices come down and wages, they remain fairly sticky. Most people don't get a raise and then get a pay cut later on. Now they might get their hours cut, but wages tend to slowly go higher. So this seems to be a good sign for the labor market. But yet again, we still hear from the policymakers, no, you shouldn't be getting these big raises. That's a bad sign. That's inflationary. But how, again, does that cause a recession? Because if people finally have more money in their pocket to spend, you'd think that would be a good sign for the economy. Well, let's dig into the CPI before we get to that. And here we can see leading the slowdown was energy, as we talked about again in yesterday's show. Gasoline putting in a -2% month over month. How about this? Piped gas services, although I wonder with the storms coming if this will hold out at -3.5% month over month. And looking at the used cars and trucks, as we've mentioned in a show again earlier this week or last week, -2.9% month over month, and that should further accelerate. Medical services also down. What was leading the charge was really fuel oil. We see food and, of course, shelter. We'll get to that here now, as shelter costs, which are the biggest services component and make up about a third of the overall CPI index, increased 0.6% last month. The smallest, get this, smallest advance in 4 months as hotel rates decline. The report showed shelter was by far the largest contributor to the CPI gain. And while rents increased 0.8% and owner's equivalent rent rose 0.7%, the cost of lodging away from home sank 0.7% after surging the prior month. Though private sector data point to a stabilization in rents in a range of cities across the country, there's a lag between real-time changes and when those are reflected in the Labor Department data. And this is a really key point. This is something my friend Jeff Snyder and I have talked about on his show, that this owner equivalent rent is effectively a made-up number by the Bureau of Labor Statistics. They really don't know where rents are at, so they try to guess and make their best guess at it. And it's a lagging effect. So what we should see in the months to come, this owner's equivalent rent should start to fall, and that will put, as you saw, a third of the CPI is looking at that, puts a lot of downward pressure on the index and leads to further disinflation. So again, we're starting to see all the signs we want. We should hear from Powell tomorrow. Yes, you got your rate increase, but that's going to change as well. And let's take a look at what the market is thinking about what the CPI report did today. Treasury yield slide as traders trim Fed hike outlook on the CPI. Of course, we note that not only did the interest rates come down on the intermediate and long end, stocks surge higher, gold rally. And why are we starting to see this? Well, let's look at this next chart, because the bond market already gets what's going on here. The stock market's just saying, hey, you raised rates and you didn't break anything. Hallelujah. Let's rally and let's go here, because we've made the case in prior shows that a Fed pause can actually lead to stocks retesting their all-time highs, and in some cases even going above that. But what is the bond market telling us here? Well, it's telling us the Fed's long done with hikes. And here we can see the federal funds rate in blue against 10-year Treasury yields in red. And all we're seeing here is 10-year Treasury yields. You start to see them lead the Fed lower in rates. And that is a good sign of where we think rates are headed. It's also part of the reason we'll see a recession. We'll get to that here in a little bit. And we'll look at a couple more charts here, because a lot of people think consumer prices lead interest rates. And really, it's the other way around. The bond market is telling us where consumer prices are headed. Here you can see now, taking that same chart, removing the federal funds rate and adding the consumer price index in blue. Here you can see the CPI index peaking, but rates had already previously peaked and were headed down. Here you can see the CPI kind of peaking in here. Rates were already heading down. CPI had peaked kind of back here, got another run. The bond market said, nah, we don't buy it. Interest rates headed lower. Here you see that again, the bond market leading the consumer price index down. So again, all the bond market is doing here is validating where interest rates are headed, where consumer prices are headed, and now where the Fed is headed. And there was a market quickly repriced, because the market was looking at a 50 basis point hike tomorrow, which is still in the cake, but next year they were at 50, and that's changed. Here you can see from zero hedge, the odds of a 50 basis point hike tomorrow are basically unchanged, which tells us that Powell is likely to follow suit with that. But the market's repricing the February odds dramatically, with 50 basis points tumbling to just 32% now from near 60%, telling us that now a 0.25% hike is really becoming what is the expectation for next year. And it makes perfect sense, because if the bond market is telling us consumer prices are coming down, then they're also telling the Fed that, hey, you're long done here, pal. You need to slow the roll. And what I expect to hear tomorrow is some I don't know if we'll see dissent in the voting, but I think we'll hear from Powell kind of backing down, that the board, the committee, is saying, hey, we maybe need to take a step back here and look. If he gives any indication of a pause, look for stocks to soar, look for rates to come down. Now, the question we started the show with, the question we need to answer here is why is a recession almost an inevitable outcome? And it comes back to the monetary system and how money is created in a debt-based system. And it's created when people borrow. And one of the challenges is when you see rates inverted like they are now, banks don't want to lend. So let's go look at what's going on with the banks first. And what you can see here is the banks are actually tightening lending standards. Now, we've talked about this in prior shows, and so let's now look at a second chart here and overlay the 10-year minus 3-month Treasury yield curve. That's shown in red. And so when the curve steepens, this is when rates fall. So red line goes up, interest rates are going down. What happens? You see the blue line continues to go up and continues to stay tight. In fact, anywhere over this black line, horizontal line, it means on net banks are tightening. So you can see as interest rates fall, banks are tightening. Now, why does this happen? It's because I know some of you disagree with me on this. I know, I've seen in the comments, banks borrow at the short end of the curve, effectively around the federal funds rate, and lend at the long rate. So if long rates are shorter or lower than long rates are lower than short-term rates, then banks really don't make money lending. So they don't lend, and that means new money is not being created very quickly into the economy, and we need that new money to pay all the debts. So you need to have a constant expansion of new debts to pay on the old debts. That's how the system works. But so when the Fed finally figures out that it needs to cut rates, well, the problem is the bond market, at least in the intermediate and long end, starts to drop even faster, meaning the Fed effectively has to chase interest rates down. They can't do it fast enough, and that leads to a constriction in credit, and that's why we end up having a recession, because the problem always comes back to there's not enough new money being created to pay on these old debts. And here you can see in this chart here, even when the Fed is cutting rates, and so we can go back to the dot-com bubble, you see the Fed cuts rates, and the banks on net are tightening standards even until the Fed gets all the way to the bottom. Here you can see again, the Fed cuts rates all the way down to zero. The banks continue to tighten standards even after that. Here we can see Fed cutting rates, banks tightening standards. So we know what the inevitable outcome here is. The Fed will eventually chase inflation down. It will chase interest rates down, but it will be way too late because they won't go fast enough to get the banks back in a position to lend. And even if they could, the problem is the lags of monetary policy, the lags from the lack of credit creation hit the economy, and eventually, like a game of musical chairs, eventually the music stops and somebody is left holding debt and they don't have the money to pay, and that's where the delinquencies and defaults eventually begin. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.